All right, so thank you everyone so much for joining today. I really appreciate the opportunity to talk to you here at MTI. And big thank you to Tom as well for organizing this. Really appreciate, he's a big fan of ITR and really think that it's important to touch base right now during a time of a bit more uncertainty at the moment. So what I want to talk about here today is, kind of how is the macro economy doing? How are your markets doing? And really connecting it to what should you be considering in your planning for your business? So we're going to format this call just a teeny bit different, but still fairly similar to prior calls. I'm going to go through some macroeconomic slides first, and then we're going to turn over to the actual report PDF to take a look at the MTI forecast as well as the end market forecast and just kind of discuss, looking at that PDF of the report, how can you be utilizing that during your planning? So we're going to start out here with kind of the more 10,000 foot view and kind of how are we doing in the economy more broadly. So certainly, there's been a lot of uncertainty or fear in the last quarter, really since the start of the year with the trade policy uncertainty. So this is just a way to quantify what a lot of people have been feeling. Not everyone's fearful. Some people are excited. Definitely a mixture of reactions here, but the uncertainty has been quite high with the policies, kind of still in that negotiation phase where we haven't really settled on kind of a solid policy quite yet. It's still being negotiated. So, um, one thing we really like to emphasize, kind of similar to when you're planning your personal finances, you want to come up with a plan ahead of time before the higher volatility or choppier times come around. So with your business too, you want to have those plans in place, different contingency plans for how to weather different economic events so that you're able to stick to some plans you've already put together for those possibilities. And really what I want to talk about here today is going to include, what are some big topics we think you should be planning for ahead of time? So some things they're probably going to include, tight labor market, our inflation expectations, so some potential margin squeeze, so really a drive towards efficiency. And in that longer term, definitely our 2030s outlook that you've heard us speak about here before. So wanted to start out with, we have a lot of fear, but we don't want that, or just uncertainty. We don't want that to be driving the business decisions. We want to be, sticking to the plan and also watching where are the leading indicators headed and how, specifically the ones we trust. We'll talk about a couple that, maybe we can not put as much weight in a few of them that can make some of the headlines sometimes. So shouldn't be too much of a surprise here, but still have growth on the horizon. So we have not changed to a recession outlook or anything like that. We still expect general years of growth ahead here. So really want people to be taking advantage of the second half of this decade to prepare for the 2030s when we see some more challenging times coming. So this is GDP here. Can't see in that first quarter, certainly made some headlines. It ticked down just the slightest amount. And that was really due to imports. They're considered a negative. They're subtracted out of GDP. So that surge of imports from, to get ahead of those trade policy changes, that was a drag on GDP. And the other component that struggled was actually government spending was a little bit lower too. But overall, consumers were spending more and there was still more fixed investment in the economy. So even though it's a little bit flat for that, very latest data point, that very slight tick down, it's really more flat. Not something that we're particularly concerned about. Might get just a little bit of noise given that trade policy kind of pulling things in or pushing things out just a little bit. We think that's going to normalize over the course of the year. And overall, still looking positive from a broader perspective. We have changed our outlooks just a little bit, but I do want to preface this with it's not a huge rethink, not a huge change, but we are just a little more sluggish in the ramp up here for cyclical rise. So kind of been, a lot of indicators where they're plateauing or in an early recovery phase, but the slope of kind of that pickup has been a little bit weak. So we did recently take down our retail and CapEx forecast just a little bit, not a huge change. I'll show you kind of the comparison of what the two, our prior outlook and our current outlook look like shortly here. And then, we still see consumers and businesses financially in a good spot. And, more on that government front as far as our debt and those factors that play in the 2030s, still on track there. kind of how this translates to MTI and metal trading. We did lower the outlook only 2% as far as the at annual average there. So not a huge change. The overall shape is still very similar. And like our prior outlook, we expect a little bit more muted growth during this cycle compared to the last one where we saw pretty robust growth rates at the peak. This one's going to be a little bit more mellow of a cycle. Partly, we're building on record highs, and that's a difficult thing to do is to really push up to those record highs. And, some certain factors that kind of helped stimulate the economy, some of the different government spending, some of that's been tapering off. Some of the, we had the CHIPS Act and some of those infrastructure bills. Some of that's going to start to gradually taper off as well. So another thing to be aware of is we did take down a few of our end market forecasts. That's part of why we lowered the MTI outlook. Those were really concentrated in auto, heavy truck, and just a little downward movement on the medical equipment as well. So we'll talk about those more when we flip to the report. Just so you're not in suspense, I'll show you the MTI forecast first, and then we're going to focus on the macroeconomy for a little bit. So just to kind of put this in perspective of how the metal trading market looks for the coming 3 years here. So I put down in the right-hand corner here, we have our growth rates and our forecast for the year ends. And I also put in parentheses how much we changed that by. So we did take down the 2025 growth rate down to 1.8%. So that's just a little bit, that's more sluggish ramp up that we were talking about. We actually raised 26 growth rate just a little bit, pushed it up there. And then 2027, that growth rate is really kind of unchanged. I think 0.1. I think we can call that unchanged. So taking a look on the chart up here, just that, we're right on the cusp of phase C and phase B. The growth rate's kind of moving a little sideways right now, but it is, starting to gain momentum there. We expect some upward momentum into really the late part of 2026 on a growth rate basis. And then a little bit of a softer year coming in 2027. That will be macro economic driven. So what that means on more the kind of annual average. So on the left-hand side of the screen here, though, those are positive growth rates. So even though it's a little bit more mellow of a growth rate cycle than the last one, that is still growth here. This is not, not a negative outlook. Generally growth a little flatter there in 27. And this is because, we're building on those record highs. We do expect inflation, so there is going to be some pricing elements pushing up here, but not as severe of inflation as we did last cycle. Last cycle that, did add a little extra oomph just how high inflation was in that cycle. So, so in a pretty good position, it's just a little bit sluggish off the start here. So let's look at the macroeconomy, kind of where is that coming from here? But overall, keep in the back of your mind, we still want to be planning for general rise here ahead. But we will also discuss, those end markets, depending on your specific exposure, could vary just a little bit how you want to plan. All right, so this slide, what I want to get across with this slide is just two positive looking indicators here. I like both of these. We have industrial productions growth rates in blue, and then in orange on the left here, we have a capacity utilization rate. And on the right, our trusty ITR leading indicator. So general rise, and both these provide a little bit of a lead time. So I think we might have someone with a mic still on. Just to.
He was using both. I don't know if they're still using both or what. But
we'll see if we can maybe silence that mic. But if you can all still hear me here, just really wanted to point out just positive signals coming from these leading indicators here. The next slide, though, what I'm going to show you is kind of more the slightly soft indicators. So when we look at the ones here, looks good, definitely looks like it's gaining momentum, maybe not the steepest slope, but improving. This next page, what we have here is non-defense capital goods is in the backdrop there in dark blue. And then on the left, I have the Purchasing Managers Index, that PMI, and really kind of been waffling more sideways lately. So haven't really seen, it's not really gaining momentum, but it's not really losing momentum either. It's kind of just waffling sideways. That's something we did factor into a little bit lower growth expectation for B2B activities or CapEx spending. And then on the right here, we're showing corporate profits. So corporate profits are at non-financial industries in particular. They are at a record high, so that is not a bad thing. but the growth rate here is a little bit on the weak side. So that could make some companies a little hesitant to invest in CapEx. That's not the whole part of the picture, I'm sure, as you all know from your own decisions on when to expand capacity or things like that. It's a factor, but it's not going to be the whole picture. So just something to keep an eye on there that might impact their sentiment when they're going to make CapEx. So let me show you here, how did we change our non-defense capital goods outlook here? All right. So what we see here is, kind of there's going to be two factors here. The current forecast and current data, those are in blue, and it's the 12-12 rate of change, or that growth rate we're looking at. And you can see it's been on a recovery trend. This data did get revised by the US Census Bureau. So you can see this prior, in orange is going to show the prior historical data and our prior forecast. So in blue, the current, in orange, the prior version. So the new data shows us that there was actually a little bit of a pullback during that time period where there was kind of an inventory glut in some industries. And I'd say this matches actually quite a few companies that we talked to did see this, falling below the zero line. Although the overall MTI, when we looked at your data, it actually didn't. You looked a little bit more like the original data, to be honest, where you had that pretty soft landing. But as Tom mentioned, kind of before the call here, is it doesn't matter what industries you have exposure to, relatively, if you had a soft landing or more of a hard landing. So we still have, looking at the forecast here, we took this down. The peak growth rate out in late 26 used to be 6%. Now it's 3.3%, but we still do have general rise ahead. So in gaining momentum through late 26, followed by kind of that softer 27 where we see a plateau. So, the factors, we kind of already looked at those: slightly slowing growth and profits. That heightened economic uncertainty could make some people a little nervous to commit to CapEx. And just, the leading indicators of PMI waffling a bit. So those factors we already mentioned. I'm just going to leave them on the screen here for anyone that looks at the PowerPoint later, but we don't need to read those. Already talked about those. Next, I want to move on here to how the consumer is doing and how the retail sector might not be as direct of a relationship to each of you individually for your companies, but the consumer really is the backbone of the US economy. So it's really important to keep an eye on how they're doing. And recently, with all the tariff uncertainty, there's certainly been, a lot of that uncertainty, the fear. It has impacted in particular some of the sentiment indexes, but I want to give you a big word of caution on using some of those. Ones you'll hear are the, University of Michigan puts out this US Consumer Expectations Index. This is the best relationship I could find with retail sales growth rate, but honestly, this is really just not a good fit for predicting these cycles. So this is one of those you really want to use quite a bit of caution on those headlines around, weak consumer sentiment. It doesn't really translate to how they actually act. And we've run this analysis for a few different series, not just this University of Michigan consumer expectations, but some other ones too. And generally, how consumers respond to surveys just doesn't relate to how they actually act. So I want to show you a better indicator. So look at this one's a little bit of a messy chart, a bit of an ugly chart. This one is a lot cleaner. It tracks those broader cycles pretty well in the retail sales growth rate. So overall, the message here too, and this is with a 12-month lead for our ITR leading retail sales leading indicator. So we've pushed this forward on the chart, and we can see that that's overall a positive sign moving forward for the retail space. So some good signs from our more trustworthy indicators, and a little bit more kind of negative evidence is in category that those soft data, the survey data that we just don't trust based on its historical relationships. So overall, still gaining steam on the leading indicators that we trust. So part of this here is that, consumers are able to make more money. So overall real personal income, so this is adjusting for inflation, that is on, a rising trend. And if we kind of trace a line on here to represent that long-term trajectory, if anything, it's actually a little bit above the normal trajectory there for income. So they have the income to spend. Employment is at record highs. It's softened. The growth rates come down just a little bit, quit rates have come down, so people are a little less confident in the job market, but unemployment's low, employment is high. People are, making real increases in their incomes here. So a positive sign for their ability to go out there and spend. And then that trickles through to, all the different manufacturers that make consumer related goods as well. So another thing we can hear is, concerns about the debt burden. So maybe the consumer's making enough money, but like, are they saddled with too much debt? When we put this in perspective, relative to, per person, but also per their earnings, since they're making more now, kind of what does the debt picture look like now? And while we do have some increase in, credit card debt as a percent of earnings, overall household debt really pretty steady. And both of them here compared to the longer term history, still in a pretty good spot. We're not looking like we were back here in the, OOs leading up to the Great Recession. We're not at those levels. We're kind of down here. We're still pretty normal with where we were in the 2010s. So this tells us that people are overall handling their debt pretty well. So I think the consumer is pretty well positioned to be driving growth ahead. Again, this is going to be a more muted cycle. That COVID cycle is just such a monster cycle here. It really dwarfs the, kind of some of those past cycles. A lot of that too is inflation. This is dollar denominated. So this one too, again, showing you the current forecast in blue and then our prior forecast in orange. So we took it down just a little in that we have a slightly slower ramp up in the growth rate. But overall, you can see that those two forecasts are overlapping quite a bit. So really, this is still a pretty similar outlook to what we were calling for before. Um, so the kind of the causal factors here is, well, income growth is growing, the pace slowed down a little bit more than we were wanting to see. Stock markets have been a little bit choppy lately, and that can impact how much more the higher income consumers are spending, some of those wealth effects. And just the heightened uncertainty could cause some people to be a little bit more conservative in the near term before they have that confidence to spend again. So just, they are still spending, they're going to spend more, just a little bit slower ramp up there. So just those factors that we've already mentioned here really want to be planning for growth on the horizon here. All right, next up here, trade, tariffs is something that we are talking about day in, day out here at ITR. It impacts everyone really differently. It depends on what markets you're in, where do you source from specifically or compared to competitors. How much pricing power do you have? Are you able to source the same inputs or have there been disruptions upstream of your business? Or is there some more onshoring, some more activity, and you're able to actually gain some market share relative to imported goods? So that picture looks really different for different companies. Just kind of on an industry level look, I know there's a lot of numbers here. In what we're looking at is just, some different kind of categories of goods here. How much of our domestic market do we either make here and or source domestically, or what percentage is imported will be in the right-hand column here. So we've highlighted in red is going to be the ones that we are really dependent on imports. So that's really going to be apparel, probably not going to have the biggest impact on this particular group, but we really produce almost no textile and apparel here in the US. That's all imported. Another one that I'd be maybe a little bit more concerned about is more the computer and electronics side. That's something that it is difficult to, we have seen some onshoring, especially that semiconductor activity recently. So we have seen it, but it's a lengthy process. We don't make all those little chips and different components and parts that go into a lot of our machinery. So if we saw some disruptions to those components, it could cause some supply chain problems, if trade gets disrupted. So far things seem like they're holding on pretty well, all things considered. But I know that trade policy is still in flux there. Another big one that we have, kind of a moderately high exposure on tariffs is in the electrical equipment and appliances side too. I will mention, these two are both also some top industries, though, for onshoring in recent years. So it's like we have recognized our exposure to imports, and people are pulling some of that activity in home as well. Some industries where we're a bit more insulated, though, so these green ones, some different kind of paper products, but petroleum, so the oil and gas sector, that's something that we're a net exporter, and food, some fabricated metal we're doing pretty good on, and some plastic and rubber parts. So based on, what your specific exposure is to these, could just be how exposed are you to changes in trade policy. Um, so this is just a way to kind of take a look at that, kind of if you can identify some that you feel that you have a little bit more exposure to, but later on we're going to get into your end market outlooks once we flip to the report. So really, part of the goal here with tariffs was to try to, entice more activity back to the US. And really, long-term trend here, we are absolutely investing here at home in the US. So gross private domestic investment. So this is a component of GDP. You can see, it does kind of every here and there some bumps in it. It'll maybe decline for a quarter, but the overall trajectory here is absolutely rise and has been recently with that first
Hey,
quarter
is Steve
data.
around?
And
Oh, he's
all
working.
right. So we're definitely are, we are investing here in the US, but also other companies or other countries, excuse me, are investing in the US as well. So we're getting some money in from, a lot of European company or countries, excuse me. So Germany, United Kingdom, also Canada and Mexico are on this list of our top 10 here. So our neighbors are investing here in the US. So really a longer term trend that we've been talking about for ITR. So even before the tariffs is that this trend towards economic nationalism is occurring where, kind of made in the USA has been gaining some more traction. So we see this trend of both domestically where we're investing in more capacity, as well as, other countries are investing here in the US as well. So this one thing that I guess kind of one word of caution is there can be some challenges that come with this. It can bring more opportunities. You could gain some market share. The one I'd be on the lookout for is kind of the pricing pressures. It can be more expensive to produce here in the United States, so that could add a little bit of pricing pressure and pressure on margins. We also demographically we have an aging population, so as those baby boomers retire,
What up?
um,
You haven't heard anything
in
back.
some areas in the country we have. We're going to have trouble sourcing the right amount of people. So if we're bringing more capacity here, unless we're really, really automating it, that's going to need more people. So more competition for the workforce is likely. All right, and one more thought on tariffs here is I think we've mentioned this in the last call as well. This is a long list. You don't have to read it now. We'll send these out. These are just some ideas if you are directly importing and have exposure here. Just some ideas on brainstorming as kind of what items you might want to do to mitigate tariffs. Also have some contact information. Someone in the Greater Crow family that's part, kind of related to ITR. They can, if you reach out to them, they would know more about this than I am. So not my specialty, but they gave us a list here to share as far as some, kind of some top items in case it helps you out with your planning more on the tariff side, or if you need a customs and duty specialist, they can help out, or I'm sure there's many other people that specialize in that as well. So if you're very impacted by tariffs, getting help from someone out there that knows kind of what's the best ways you can navigate the new environment. All right. And then inflation and interest rates. This is one that, I definitely, when I bring up these topics, I don't want to just be like some, kind of economics textbook sort of thing. This is, very real, very impactful for businesses and especially for planning. So really want to make sure I'm connecting this back to your plans. And if I'm not, somebody call me out on it. So pricing wise, do expect, we really do expect some higher pricing pressures coming back around. So this is the US producer price index. We have the growth rate over here on the left. You can see that it already reached a cyclical low and it's been kind of gradually rising and we have it continuing to rise. So, by the year end, we got like 2.6%, but next year going to pick up to 3.4%. And then it'll soften a little in 27 when we have that softer macroeconomic cycle. But we really need to be planning ahead for this inflation. So, analyzing our cost strategy, how are we building in, kind of insulating our margins? Can we, improve on efficiency to protect our margins? Or can we have can you very actively be passing along those price increases in a very timely manner. Um, but really prices, this is a very overall broad, this is, producer prices for final goods. And I want to keep in mind that commodities, and, individual commodities and some intermediate goods are more volatile than this. So that typically means that they'll have, lower lows. They'll contract a bit more at sometimes, but they'll also have some higher peaks as well. So, this is for final goods, but keep in mind that behind this, there can be some more volatility for intermediate and commodities as well. So those input costs could rise, this doesn't mean that your input costs will all rise 3.4%. Those could pick up a bit more than that, depending on the particular input. So also from if we look at this from a CapEx perspective, if you're looking to add capacity to your shop, something to consider is, if you're buying equipment, it's going to cost more in the future. So, depending on when you want that capacity to come online, just keep in mind that your budget for that will need to increase over time here. So, um, next, I wanted to hone in on, something else here as far as one of those specific costs that the metal trading industry has a bit of exposure to specifically is, electricity costs have been on the rise. And this is something that we are, definitely keeping an eye on. We want to make sure you're planning in the future and have a strategy for how to deal with this because we're seeing, quite a plethora of different components here increasing demand for electricity. So, EV adoption, the data centers in particular, that can be a little bit regional if you're in an area with a lot of data centers being built. But just AI picking up, that's suggesting that the demand on electricity is going to be increasing over time. So having a plan on kind of like how do you source your electricity? Do you have other alternatives? And what can you do to mitigate if those costs kind of pick up in the coming years because of these trends? So just to kind of visualize this here, this will be we have the electric power producer price index here. So this isn't a growth rate. This would be kind of mirroring the actual level itself. So you can see, definitely picked up quite a bit there with inflation. But we're going to expect another ramp up here. And part of that is we have data center construction really taking off here. So that's that light blue line there. So as the data centers are taking off and they're very power hungry, just makes us a little concerned as far as electricity availability or costs in the future. So something I want you to be planning for in the future. So next on, so kind of related to inflation or pricing, but specifically more on the lending side. So if you're making some CapEx decisions and you want to invest in your business, um, interest rates really, we see them being quite sticky in the next 4 quarters, so maybe even really picking up towards the end of this year to early 2026. So we're not seeing a lot of relief coming, really any relief coming on interest rates. So if you're looking to invest, I wouldn't try to time a low in interest rates. I would focus a lot more on when do you need the capacity? What is the payback period of adding that capacity? And really keeping the 2030s in view too. You don't want to saddle yourself with a lot of debt or super increased capacity right before the 2030s. So kind of timing is going to be key here. So I don't by any means to say don't invest in your business. We think investments are really important, but just consider the timing of those investments, how much, do you want to focus on investing in efficiency or adding capacity? Kind of, I would take a good look at our market index or outlooks when you're making those decisions as far as the timing and kind of when is it going to pay itself back. So yeah, really just not a lot of relief here. This also can impact, some of the important end markets. So kind of automotive, heavy trucks, things that can be financed, construction machinery, the construction itself, some of those more interest rate sensitive machinery markets. Not going to be a whole lot of relief, but we also, we do think that people are going to get used to interest rates. They do look quite high right now when we look at it charted here. If we think back a few more decades, so, this is relatively not particularly high in the grand scheme of things. So we do think the market's going to kind of adjust to a new reality for interest rates. All right, so I think we're getting close to the end of the slides here, and we'll switch over to the report shortly. Here we have labor, though. Not going to show you a lot on this just because we all know the labor market's been pretty tight. It's been a little bit better lately, from what I've heard, a little easier finding the right people. But those demographic factors out there, there's still a shortage of workers, especially sometimes in particular skills. And we think that's going to continue as the baby boomers are retiring. And labor costs are just something we really want to keep in mind here. So through 2029, we're projecting a 28% increase in labor costs here. So we have annual earnings showing in the background there. On this chart, I just wanted to point out, earnings do tend to increase. That's, quite normal. The pace, though, the slope of this line has certainly picked up quite a bit here. Part of that too is inflation picked up. People want to be compensated for that. So, when we have that next round of inflation coming, keep in mind your employees are going to want to be making more, and it could be a little bit of a competitive market out there. So we really want to focus on your company culture as well. Other ways to keep people through, positive mentoring relationships. It's not always all just about dollars, but do keep in mind that cost is going to increase over time. So 28% increase is likely in labor costs through 29. I just like to look at a map, so this one's kind of just for fun here. Just highlighting there are geographic differences here. So looking at population growth by state. So this could have some implications for local demand as well as local labor availability. But some of those areas with more growth, they also do have higher costs as well. So something to consider. All right, let me wrap up our macro slides. We'll have a couple 2030 slides, and then we're going to open up the report here momentarily. So yeah, just keep in mind, real incomes, they're in a good spot. I know some people are getting squeezed, their discretionary income if they're on the lower income spectrum. So I'm not meaning to say that everyone's, feeling amazing about the economy, but overall, consumer looks pretty solid right now. So do the businesses. Inflation's going to be picking up, so we want to be planning for that, driving efficiency to protect our margins and really expecting things to start to improve later this year, be a little bit more noticeable that it's better later this year. And in 26, we see a better year. So just some next steps here, planning for those labor costs, setting a little bit more positive, more aggressive goals in the next few years. We want to, really be pushing our business, pushing our profitability, putting ourselves in financially a good spot ahead of the 2030s there. So kind of those 2030s that we've talked about for anyone that might be new on the call here, we're seeing a much more challenging business cycle coming in the 2030s. And there's some long-term factors that have been in play for decades that are, kind of going to culminate in a harder cycle there. So one of the big things is demographics. We have a larger retiring population. The healthcare costs in the US are quite high. The different entitlements that the government needs to, has to be able to cover. Inflation is a bit of a challenge, as well as really ultimately our national debt is in a pretty tricky spot, kind of hard to reverse at this point in the cycle. So we think this confluence of factors is going to make for a very difficult cycle in the 2030s that we want to already be planning for. Are there ways to either diversify into businesses that are a little less exposed, or just get your finances in a good shape, be a little bit more conservative as we get closer to it as far as holding a cash balance. So so there's things that we can do. It is getting closer from a planning perspective, but we do have some time here. So one more illustration on kind of the debt. The government debt is really a huge portion of this here. So we have debt as a percent of GDP. So that means that our debt is outstripping our GDP. So again, we say at ITR here, we are apolitical. And I think that this chart really illustrates it the best because those are decades there. So both parties were in power over that time. This is not picking on one side or the other. Just overall, the longer term trend here is that debt has, really gained quite a bit of momentum, and this is going to be a hard trend to reverse. So we still think that we're on for the 2030s. Haven't seen any major changes yet to impact our thinking. All right. So next up, what I want to cover is, taking a look at the report. So, when you're looking at this on your own, so you can kind of know how do you use this report. All right, so what I would start out with here is, our overview page. I know not everyone has the patience or the time to read all this, but if you really just want to know kind of how does ITR see the economy, we're updating this every time you get it. What's, kind of some relevant events, as well as we're going to include in here, some things that we want you to be planning for here are going to be included in here. So kind of on a broad level, this is talking to a wider audience, but kind of what do we think you should be planning for and what's going on in the economy. So this is going to lay it out for you, but I know it's a little bit long, so it's not for everyone. What I wanted to highlight here is on this terminology and methodology page, there's some links here to videos, and they can show you how to calculate your own rates of change. And that's something that I'm really going to want you to be doing when you're using the report is, calculate that 12-12 rate of change, that growth rate on your own, so you can compare it to, how are you doing relative to the overall MTI numbers? How are you doing next to your specific end markets too? So there's a lot that we can gain from kind of trying to determine, are you outperforming? Are you underperforming? What might be going on specific in your data? And, kind of how can you use those indicators then to plan? So this page here, we're going to have a, 10,000 foot view, a dashboard of, overall MTI. We have industrial production and non-defense, so kind of B2B spending. So a broad look. And then we get into a lot of the really top end markets for metal treating down here as well. We can see the current business cycle phase, as well as the growth rates for the next 3 years. So if you want just a real quick look, this gives you that 10,000 foot view. All right, so already showed you a variation of this, our outlook for MTI specifically. So I'll zoom in just a little bit here. So again, we took the forecast down just a little bit. I do think it's interesting that, you did have a soft landing to the cycle here thus far. And historically, your industry is a little bit more prone to some contraction. So I am kind of curious, or if Tom has any ideas on this one, that could be a pricing element, or it could be, that you guys are managing your businesses really well. But compared to overall non-defense, looking pretty good here that you had that soft landing. The growth rate slowed a little bit, but you haven't experienced marked contraction. But this might be, this is a mix here. Might depend on which end markets you have exposure to. Some of like auto, heavy truck, we're in a little bit more strained of a position this cycle. So on the page here, when you open up the report, got a headline overall. You can see our outlooks here. Personally, I think a chart's worth a thousand words. But we also do explain kind of any changes or, some of the leading indicator evidence that we're seeing down here below. So overall, have a growth outlook here, growth through 26, and a plateau in 2027. I've already touched a bit on kind of the industrial outlooks looking pretty good. Same with B2B spending. Give me just one second. So Tom, do you by any chance have any ideas on kind of the soft landing that MTI has gone through?
I mean, it really just kind of depends on where people are in their marketplaces. We talked before we got on the call, diversity of market. I mean, I've talked to a lot of people who they're like, it's just really busy. So there's many industries that did not come in for the soft landing. They're still just raging with demand, and that's kind of all over the place. Trying to understand exactly why, but I mean, most people that I've talked to are saying things pretty consistently, continuing to grow, at least in the heat treating side.
Yeah, that's really quite good to hear. Thank you for sharing that. Yeah, let's look at some of those. So starting out with construction machinery here. All right, thank you. Takes a little toll on my voice to be talking for this long. All right, so construction machinery, this data was revised by the source. So that is the US Census Bureau. So they just do an annual revision. So it looks just a little bit different than before. So we did adjust the forecast, but it's not because we see a change in the end markets. It's really just adjusting for the historical data revision here. So have a little bit of a dip in the near term, but overall a positive outlook for later this year and in 26, and then flatness in 2027. Oh, all right. So not a huge change there. Light vehicle is one of the ones that we did change. So we did take this outlook down just a notch, and we now have a negative year end for 25. So we had a pretty flat previously, just a little bit more of a tick down. So ending the year below the year ago level. This is really because the auto industry has very complex supply chains and is quite exposed to the current trade war. So we're a little bit concerned about, Canada and Mexico. We took down our respective outlooks for those two countries. So that's part of the tariffs are a big part of this. And also higher prices could cause a little bit of a cool down on the demand side. Although we did see some consumers going out there and trying to buy ahead of the tariffs. Uh, so a little bit of a downgrade here, but not too bad. So just a little bit, still some sluggishness here. The growth's mostly going to be concentrated in 2026. All right, heavy duty truck. This is another one that we lowered. So these are two of the markets that played into our lowering of the overall MTI outlook as well. So heavy duty truck production, the more the freight side of things, it had been on kind of a recovery track, but it's really been kind of stagnant lately. So the trucking side went through a bit of a struggle. They had a harder landing previously, and it looked like it had been gaining steam, but it kind of has petered out a little bit. It's a little bit on the weak side. Took this down just a notch, as well as, this is also a interest rate sensitive market. So it's still declining here. It's in phase D here. We haven't seen that positivity in the growth rate yet, that kind of tick up. But we'll be on the lookout for that kind of in the middle of the year here to transition to a recovery trend. About 2 more quarters of decline on the outlook here. And then we're definitely going to get a bounce. It's going to be a little more in 2026 rather than this year. So kind of auto and heavy truck, the lows just kind of pushed out just a little bit on these, but we still have a positive outlook for 26. And then kind of that flat cycle coming in 2027. All right. And then oil and gas extraction. On this one, I did want to mention this is specifically the extraction step. So it is at record highs. The growth has been slowing, but we're not expecting a hard landing here. Overall, the demand picture is still pretty positive as the industrial sector, both here in the US and globally, picks up. We're already seeing a little bit of positivity there. That's going to, improve the demand base for oil and gas products, since that is an input in, so many different things, as well as just the fuel qualities of it. So we have a positive outlook here, just a little bit. The growth's going to slow just a smidge more before it starts to pick up again. So this is at the extraction stage. So if you're able to isolate, like in your own data, if this kind of bucket of orders or sales is, specific to XYZ industry, if you can break that down, you could run the rates of change for, and compare them next to each of these individual industries as well. So how are you doing, not just compared to overall MTI, but how are you doing relative to, the oil and gas sector? All right. So for that overall oil and gas, one of the things I really want to highlight here, though, is if your data looks a bit different than this, it might. It depends on what stage you are along this supply chain. So if you have more exposure upstream, so more the drilling and exploration side, some of the machinery that goes into that, we did see a harder cycle there rather than extraction. So it's going to feel different depending on which stage you have the most exposure to. So extraction had a soft landing, pretty positive, but some of the machinery tied to mining for the drilling and exploration stages did have a contraction, but like the rig count and the oil well drilling production data series, those are in phase A recovery now. So we're seeing some improvement upstream. Oil prices have been a little bit soft here. We did take down our outlook for oil prices. They're well within profitability for existing wells, but they're a little bit uncomfortably close, I'd say, to the break-even rates for new construction, or is it not, sorry, new wells. So that could cause a little bit of pause on some of that upstream activity, though more the drilling side of things. I know this administration's a little bit more friendly, so that could add a little bit of oomph to the kind of upstream. But oil prices right now, just something to kind of keep an eye on how those are doing. Part of that too is OPEC sometimes comes in there and throws us a little bit of a wrench. So they have had some actions trying to increase supply on their side. So over here and there, that can kind of mess with our pricing forecast a little. So, and kind of the recession fears, I think, also played into a little bit of softness in oil prices in the near term. But we do expect those to start to pick up again here in the coming quarters. The outlook is for a bit of rise in the oil prices as well. And oh, sorry about that. All right, so moving on here to medical equipment. This is another one we did take it down just a little bit here. Um, so overall, we think that the medical market, there's a lot of positivity coming from kind of the aging population that's going to have all those medical needs. So from a demand perspective, it's in a good spot. This one can be a bit exposed to international trade. So how exchange rates are doing, different trade policies. So it just was a little bit, the latest data was suggesting that the low was going to come just a little bit later. So it kind of kicked out the low a little bit more flatter on the bottom there before it kind of picks up. But we think we're in late phase D and should be turning a corner here on the growth rate shortly. All right, so aircraft here, this market has had a lot of supply side issues in the last few years, particularly surrounding Boeing. Um, So that's been kind of a challenge. Whereas on the demand side, things have been pretty good. Like TSA travel numbers, people are out there flying quite a bit. When we look at air transportation revenue, it's at record highs. The growth rates have been just a little sluggish, though. So that and interest rates, it could cool down airline or aircraft demand just a little bit. But we're not particularly concerned about this market at this juncture. It's, as long as, or Boeing in particular has a pretty good firm backlog going for them. So we see, given the lengthy time it takes to produce these planes, there's still general growth on the horizon. We do have a little bit of a blip here, kind of flat, ticks down just a little bit. So that's in kind of late this year, early 26, but overall a rising trajectory here. Demand looks pretty good. This industry could be a target for some of the trade policies, but so far Boeing's weathered that pretty well. It sounds like, if one country or China, I think, threatened to not take planes, but then some other places were like, oh, we'll take them. So far pretty good on the civilian aircraft side, and more on the defense side too. Certainly seems to have some good demand as well. So I think we might be at one of the last ones here. If you have computer and electronics, this one really more the high tech side. This has, I mean, if you look at that trajectory, it's really quite positive. This has been where a lot of the growth in the industrial sector has been more on the high tech side. So if you don't have exposure there, if you're able to gain some, might be a good idea. This is doing better than kind of more of the legacy or traditional manufacturing is doing. And this is an area where we could see more onshoring, because it's something we're currently a bit exposed to tariffs on. So overall, have a pretty strong trajectory here through 26. As far as the overall trend being rise here. So we think there's going to be some opportunities on the high tech side of things. Again, though, 27 will be a little softer, but that's driven by the macro economy. All right, one last one here. So farm machinery shipments. So this one, we did take it down just a notch too. This was really just due to the data revision. So again, the Census Bureau issued an annual historical data revision. So we just adjusted for that, but it's not a change in our underlying thinking. Still pretty similar shape to the overall forecast here. So this one has been having, they've been having some struggles as far as, farm proprietor income, high interest rates. This market's been a little bit soft. We do see some positivity coming, but it's going to be just a little bit further before we reach that kind of low point and turnaround here. So kind of the larger machinery, the heavy truck farm machinery, those are struggling a bit more, the very interest rate sensitive ones, whereas more the high tech is in a little bit better of a position. So I want to make sure I give us some time for some questions here. Just wanted to mention one last thing about the report is if you scroll down, we always have these management objective pages in the back. So throughout the report, we'll kind of sprinkle in some suggestions as far as, here's what we think you should be doing with this information. Here's some things you need to be considering and planning for. But if you want to brainstorm a bit, we have some lists back here as what are good management objectives for phase B accelerating growth, or looking a little bit further out once things soften a bit. How about in phase C? So if you just want to kind of brainstorm and get some ideas, I would flip here to the back just to get some, kind of formulate a little bit of some ideas here. All right, so I know I've covered quite a lot. My voice held in a little better than last time, so appreciate everyone who's patient last time. So I want to open up to questions, or Tom, if you have any questions.
I guess one of the questions I always look at is when you look at demographics, the millennial generation, if you look at 20-year bands, they're about, if not a little bit larger than the baby boomers. As the baby boomers are obviously moving all in 2030, they're going to all be, I'm the last one, so see y'all later in 2030 in retirement.
Yeah.
But in 2030, they'll all be in Social Security and Medicare, really, which is two of the things you talked about. So is there any underlying theme that there's a possibility that the millennial generation could begin to generate the kind of incomes and tax dollars that could help soften the blow of the so-called depression that they're predicting potentially?
Yeah, one of the ones we've been getting questions on is kind of some of the enthusiasm around AI is, can we become efficient enough? So maybe, not saying to cut jobs or anything, but like when we have fewer people to work with, can we still be producing more with fewer people? So people still employed, but they're able to produce more per person. So kind of that's where like utilizing, um, you know, automation or AI could boost our efficiency. So definitely technological change can be a big portion of the business cycle. We think that, some people ask us, are you going to call off the 2030s outlook because of AI gaining hold? We think it's just a little bit too new in the process to fix the trajectory that we're on, but we think it's going to help us getting out of it. So we still think, we just think the adoption timeframe, people are a little optimistic as far as when it's really going to take hold and give us all those efficiency gains. So I think they're, from a technological standpoint, I think that's more of what our potential saving grace would be. I mean, we've seen a lot of that in the past as you know, different technologies can really change how we do business and even just our consumer experience and have added so much to our quality of life. So the
Right.
technological change is kind of a big external factor in economics. Yeah. Did I answer your question?
Yes. Well, I mean, we appreciate these quarterly reports because, I mean, it's important to pay attention to that data because with the 2030 potential predictions and the potential for that, it changes in light of kind of decisions that you make today. And I've already talked to some members here at our executive training program, how they're going through making changes differently because they understand they want to be prepared if it happens. If it doesn't happen and things continue to grow at some level, you're at least leaned out heavily into technology and you're as efficient as you can be. Your profitability in 2030s will be maximized because you prepared for that instead of waiting to 2029 going, wait a minute, what happened?
Yeah. Yeah, it's really like the more time you have to plan, the better. And I would say, you know, oh gosh, Brian and Alan have been calling for this for way longer. I think they wrote a book in 2014, but maybe have called it even before then. Um, and I think that it was harder to see kind of it was a little harder to believe back then. And over the 8 years I've been at ITR, my confidence in this has increased over time. Is kind of, the closer you get to it, you can kind of see some of the inner workings of like, oh, how might that actually come about? Like saying, oh, there'll be a surge in inflation. They called that in 2014. They were talking about how inflation is going to take off. Um, but before the pandemic, I don't think anyone would have, they'd been like, well, what are you talking about? Inflation's very low. Where would that come from? So we've already gotten kind of a taste of inflation again and interest rates being higher. So some of those that they already, that Brian Allen were calling as part of their outlook of, those are going to reverse course. We're going to see higher inflation and at least leading up to, not so much in the 2030s, but leading up to it and higher interest rates as part of that too. Um, so yeah, the closer we get, then also the time frame as far as I know that like when you make some business decisions, it doesn't happen overnight. Adding people, training them up, building a new location, that takes time. So really want to consider, when is that capacity going to hit? So when do you need to be preparing so that the market, the higher level of activity in the market's there and you can serve them, but also being careful that you're not overbuilding too late in the cycle.
Right.
So, really expanding capacity in 28, 29 would probably be pretty risky. So the sooner, you can make some of those, also the efficiency gains, the sooner you can make them and start benefiting from them, then the sooner you can be taking, good care of your balance sheet, you know, potentially having a little bit of extra cash coming in. So want to make sure your kind of financial picture is in the best shape leading up to it, getting a little more conservative closer to, but already considering that with some of the CapEx, it might take a little longer.
So I think those are great lessons. And, we took away a bunch of lessons from the 2009 and 2015 market jumps. And I asked a lot of members, I asked members, what are you doing to minimize the impact? And two things were consistent of all when I would ask people, how's business going in 2009 and 10? A lot of people are saying business is horrible. Sales are down 70%. But then you got other members that were like, our profits are record profits. And
Mm,
so I kind of kept in my mind, what's the combination of those two things? What's in common? And there were two big things that I'll encourage members to be thinking through between now and 2030: diversity of industry served and diversity of customers. So no one customer or industry, if a downturn occurred, could wipe out your profits and your sales and business. The second thing was low debt. Start preparing today to then to minimize debt in 2030, so that's not a drag on your business. So those are the three common things I found. The difference between people that were flourishing through the bad time and those that were not was, again, diversity of industry and diversity served and diversity of customer, and then low debt.
yeah, absolutely. I would agree with everything you just said. I think that kind of calling back to those prior cycles can be helpful in that brainstorming of like, what do you wish you did before the Great Recession? So I'm not saying do that tomorrow, but just keep in mind, the 2030s outlook we have is a bit worse. It not just a bit, it is worse than the Great Recession in far as length and depth. So, if you can remember, if you were in the business back then and you know what that felt like, and you're like, oh, I wish I had set myself up better in these different ways, try to remind yourself of that so that you're setting it up and you're ready to go, kind of later in, kind of 28, 29 before things start to soften up.
Well, and I think another lesson is it's always in good times, projects come along, and sometimes people will find that one industry or that one customer that's just it's driving up the percent of your sales because you're riding that wave because it's just a growth industry. But you want to ask yourself, what happens if that sales figure cuts in half from that one customer industry? Are we prepared for that? And know that if you're riding a wave like that, you need to really look at how you can manage that so you're not too caught up in that one, because it's hard to shut off a spigot when it's running hard, but if it
Yeah.
does turn off, it can be instantaneous.
Yes, absolutely. Yeah, don't, kind of minimizing that exposure risk, or that concentration risk, or all your eggs in one basket, that would be very dangerous going into the 2030s. So yeah, diversifying, keeping in mind, who's the end client down the line, maybe not directly your client, but who eventually is the client, and, how are they likely to be impacted? Are they a different, kind of downstream client than in a different industry?
Right.
Kind of, yeah, diversifying into which ones seem a little bit more recession proof, versus what's a little bit more discretionary and more likely to dry up.
Yeah.
Yeah. All right. Any last questions, Tom? Or
No, I think that's it for me. If anybody else got any.
okay. Yeah, I know the 2030 sounds scary. Just hope you have, definitely do encourage you. I know can't hurt to have some plans and have them, even if you're a 2030 skeptic, to have some, have that contingency plan out there, and at least give it a good amount of thought as far as planning for that possibility. While times are relatively good, planning for it now when we're a little bit calmer, and when you have time to put some of those solutions into place, like Tom's been talking about here. So, again, thank you so much, Tom, and for everyone who attended here at MTI, everyone that watches after the fact. Really appreciate you here at ITR. And if you have any questions, feel free to email Tom or email myself. You can forward it along to me, and we're really happy to help out here.
Thanks, everyone. Thank you, Michelle.